In the first quarter of 2026, Mercado Libre reported $8.8 billion in revenue, a 49% increase from the previous year. They beat consensus estimates by over $500 million, and yet the stock fell 7% in after-hours trading. To understand the sell-off, we have to look further down the income statement. Net income dropped 15.6%, and operating margins contracted to 6.9%. Trading algorithms and analysts viewed that specific margin compression as a sign of a mature retailer overspending on logistics and credit. In reality, management is executing a deliberate, highly calculated land grab across the entire Latin American digital economy. These falling profit margins are the specific cost of securing a dominant position in e-commerce and fintech. The strategy follows the Amazon playbook, sacrificing near-term earnings to subsidize shipping, build logistics infrastructure, and lock users into a digital ecosystem. Investors often value this model in hindsight, but the actual period of margin compression required to build it often triggers market concern. Mercado Libre's first quarter performance is a translation of that playbook applied to a Latin American market of over 650 million people. Valuing the business today requires tracking their market share capture rather than quarterly earnings. To see where that capital is going, we have to look at the core commerce division in Brazil. Management lowered the minimum order value for free shipping, choosing to absorb the fulfillment costs to attract more buyers. On this chart, the red line representing profit margin dips. In response, items sold increases by 56%. A third variable shows the scale reward, per unit shipping costs falling by 17%. At this break-even threshold, lower-priced items become profitable to ship. Mercado Libre is using its balance sheet to treat logistics losses as customer acquisition costs, putting pressure on competitors. This commerce strategy supports the fintech division, Mercado Pago. Management is lowering interest spreads and issuing credit cards to unbanked consumers. Credit cards now account for 46% of Mercado Libre's $14.6 billion credit portfolio. This flywheel explains the logic. A subsidized marketplace purchase generates data, which the fintech arm uses to underwrite credit, leading to higher engagement. Accepting higher risk provisions today is the calculated price for owning the digital financial infrastructure of the region. These investments coincide with the arrival of Asian e-commerce giants like Temu, Shopee, and TikTok Shop. While foreign competitors rely on international shipping, Mercado Libre's investments in 14 new local fulfillment centers and credit data create a localized defense. These capital expenditures are structural defenses meant to lock out competitors before they gain a foothold. Achieving scale and future profitability requires a company to sacrifice margins in the present. Algorithmic trading reacts to short-term misses, while building a dominant ecosystem requires longer-term capital commitment. When the market reacts negatively to a missed consensus caused by ecosystem building, it creates an opportunity to evaluate the business differently than the algorithm. This video is for educational and informational purposes only. It is not financial advice, and you should always